Okay, so my name is Jessica Chisholm. I'm a CPA just outside of Seattle with Huddleston Tax Consulting. Um, let's see. So this is our website, huddlestontax.com. If you need to get any more information about us, or if you need any help with tax planning, tax preparation, or other small business consulting. And also, if you didn't register already at smallbusinesswebcast.com, you should go ahead and do that so you can be made aware of any future webcasts we might have. Like tomorrow, I'm doing QuickBooks Overview Essentials Every User Should Know. On the 10th, John Huddleston will be doing LLCs and S-Corps Explained, using them to reduce taxes. On the 16th, I will be doing tax deductions for construction, architecture, and engineering firms. And then on the 19th, Jennifer Zhao is doing 7 tax tips for the self-employed. And we're constantly adding new webcasts, so you should check back and make sure you're registered there so you find out about any new ones. Okay, so this is Tax Savings with Real Estate Ownership Explained. The objectives of today's webcast are to go over tax savings with your personal residence, tax savings with rental properties, what it means to be a real estate professional, and then also what the tax consequences of house flipping are. So first, when you're thinking about owning versus renting, it's good to take into account the tax benefits of owning a personal residence. When you own a personal residence, usually you're able to itemize on Schedule A, something that a lot of people can't do unless they own a home. The things that you can deduct on Schedule A are the mortgage interest that you pay on your home loan, points that you pay on the purchase of your home loan or on a refinance. When you purchase a home and pay points, you can write off on Schedule A all of the points paid in the year to purchase. When you refinance, you would amortize those points over the length of the loan. So if you refinance with a 30-year loan and you had $5,000 in points, you would divide those $5,000 by 30, and you would deduct that amount each year on your Schedule A until you either sold your home or refinanced again. The other thing you can deduct is qualified mortgage insurance. This is what you pay if you don't put 20% down on your home. Most banks require you to pay qualified mortgage insurance, and this just recently in the last couple of years became deductible. And also the real estate taxes that you pay on your home are also deductible. So those are some of the ways that owning your home can help you save money on your taxes, because you can't deduct those kind of things when you rent. So it will reduce your taxes. Another thing with your personal residence is the principal residence exclusion when you go to sell your home. When you sell your main home, you may be able to exclude up to $250,000 of gain or $500,000 if you're married filing jointly. This is the case if you meet the ownership test. So you have to have owned the home for at least 2 years in the 5-year period ending on the date of sale. You must also meet the use test. You must have lived in the house as your main home for at least 2 years during the last 5 years ending on the date of sale. And during the 2-year period ending on the date of sale, you cannot have excluded gain from the sale of another home. So basically, if you own a home, you buy a home, you live in it for a year, then you move and rent it out for 3 years, move back, live in it for 1 more year, and then sell it, you technically have lived in the home for at least 2 years and used it for at least 2 years. You've owned it for at least 2 years. Obviously, you've owned it for 5 years, and you've lived in it for 2 years. So you would be able to qualify for the principal residence exclusion, even though it was rented out for those 3 years in between. So the next thing we're going to talk about is when you own a rental home. So rental income is reported when it is received. So if you have a renter in a home